Hello everyone, my name is Roza and today we're going to be presenting you our online moderation about financial performance measurement. Firstly, we need to define what financial performance measurement is. It is an analysis, measurement of how well a company uses their assets in order to generate revenue. So that's why the goal of financial performance measurement is to increase the wealth of the stakeholders. Creditors and investors use financial performance measurements to judge the past performance of a company, present position, and future potential, and of course, the risks of a company. Creditors they use this whole information in order to make reliable loans to get interest. At the same time, investors use the same information in order to make good investments to get a higher return. Three standards of comparison commonly used in evaluating financial performance are rule of thumb measures, a company's past performance, and industry norms. Rule of thumb measures are weak because of a lack of evidence that they can be widely applied. A company's past performance can offer a guideline for measuring improvement, but it is not helpful in judging performance relative to the performance of other companies. Although the use of industry norms overcomes this last problem, its disadvantage is that firms are not always comparable, even in the same industry.
Hi, my name is Aruzhan, and I'm going to discuss two questions. The first one is, what are the major sources of information about public corporations? And the second one, what is executive compensation? So let's go through them one by one. The very important source of information is considered annual report and interim financial statements. They show us the situation in the company. They show us any changes that may occur in the earnings of the company. The next source of information is considered reports filed with SEC, Securities and Exchange Commission. This is required for the companies in the United States. So they have a lot of forms. The most important ones are 10K. It is the annual report of the corporation. Here we can find even more information, financial information about the company, rather than in the annual report of the company itself. The Form 10Q shows us the quarterly report of the company, and the Form 8K, the current report, that must be submitted within a few days of any significant change in the company, shows us the current situation of the corporation. And the last source of information is periodicals and credit and investment advisory sources. For example, the Wall Street Journal, Fortune, Forbes, any other advisory companies. They show us the current events in the financial market, and some of them are published every single business day. So now let's move on to executive compensation. One of the intent of Sarbanes-Oxley Act of 2002 was to strengthen the corporate governance of public corporations. So under this act, a public corporation's board of directors must establish a compensation committee. In simple words, a compensation committee is a group of individuals that have been appointed to evaluate and set the pay rate for senior level management. The committee may also be involved in the selection of other compensation options such as stocks, bonuses, and profit sharing. The establishment of corporate goals, objectives, and awards relevant to the compensation may also be handled by the committee.
Hello everyone, my name is Karina and today I will try to explain you the horizontal analysis, vertical analysis and ratio analysis as well. Horizontal analysis involves the computation of changes in both dollar amounts and percentage from year to year. Trend analysis is an extension of horizontal analysis that is calculating the percentage changes for several years. The analyst computes the changes by setting a base year equal to 100 and calculating the changes for other years as a percentage of the base year. Vertical analysis uses percentage to show the relationship between the component parts of financial statement to a total figure of the financial statement. The resulting financial statements, which are expressed entirely in percentages, are called common size statements. Ratio analysis is a technique of financial performance measurement that identifies the key relationships between the components of financial statement. To interpret ratio correctly, the analyst must have a general understanding of the company and its environment, financial data for several years or for several companies, and have an understanding of underlying data for numerators and denominators. And now it's time for the last and probably the most important part of our video. It's thank you part. Thank you for your attention.